Hello, and welcome back to another financial accounting video. In this video, I will provide an illustration of how economic events are recorded in the accounting system and aggregated into financial statements. Put on your thinking cap because this video is going to cover the basics and more. Recall that the objective of financial reporting is to provide useful information to investors to help them make good decisions. One way that financial accounting accomplishes this objective is translating the company's economic events into financial statements. We use a few basic rules to record the company's economic events in the accounting system. First, the accounting equation should remain in balance after each transaction is recorded. Second, separate accounts are used for each financial statement element. We typically illustrate accounts with a T account, as shown here. Third, the left side of the T account is the debit side, and the right side is the credit side. Fourth, the type of account determines how we record increases and decreases in the account. For example, cash is an asset, and asset accounts increase with the debit. Expenses and the dividends account also increase with the debit. Liability, equity, and revenue accounts all increase with credits. They say that practice makes perfect, and that to become an expert, you need to spend at least 10,000 hours of practice on a skill. So, we better get started. Let's assume that you have started your own business with an initial investment of $12,000 from your equity investors. That is, your awesome parents. To record the increase in cash, we debit the cash account. To record the increase in common stock, we credit the common stock account. The cash collected from your stockholders, aka your parents, will be reported on the balance sheet in the cash account and also reflected on the statement of cash flows. The statement of cash flows classifies cash into three groups: operating, investing, and financing. Cash obtained from investors is classified as a financing activity on the statement of cash flows. Also note that the beginning balance for these two balance sheet accounts is zero because this is the first year of our business. Next year, the beginning balance for the balance sheet accounts will be the ending balance from this year. Let's assume that you need more than $12,000, so you also obtain a loan from your best friend. To record the increase in cash, we debit the cash account. To record the increase in debt, we credit notes payable. The cash obtained will be reported on the balance sheet in the cash account and also reflected on the statement of cash flows as a financing activity. Next, we purchased 2 parcels of land for $10,000. To record the purchase of land for cash, we need to increase the land account with a debit. To record the payment of $10,000, we credit the cash account. Also, on the statement of cash flows, the cash used for the purchase of land will be reported in the investing section. After recording this transaction, the T account for land will reflect an ending balance of $10,000, and the T account for cash will have an ending balance of $7,000. Next, we prepay $5,000 to rent equipment for the year. Although the $5,000 rent payment will end up as an expense on the income statement, we do not initially record it as an expense. Rather, prepaid expenditures are considered assets initially. As such, we will increase an asset account called prepaid rent expense and decrease cash as illustrated. On the statement of cash flows, the cash used to rent equipment will be reported in the operating section. After recording this transaction, the asset account prepaid rent expense will have a balance of $5,000, and the cash account will have a balance of $2,000. Finally, we use our new equipment to provide lawn services to companies around the Wasatch Front. As payment, we receive $10,000 cash and a promise from our customers to pay the additional amount owed, $4,000, over the next 30 days. To record this transaction, we will debit cash for $10,000. We call the promise of payment from customers an accounts receivable, referred to as AR. AR is an asset and thus increases with a debit. The credit in this transaction is to revenue. Notice that revenue will increase net income, and net income is a component of retained earnings, which is reported on the balance sheet. On the statement of cash flows, the cash received from customers will be reported in the operating section. After recording this transaction, we have an ending balance in cash of $12,000. Revenue reflects a $14,000 balance, and we have $4,000 of AR. Next, the company pays $4,000 cash for business expenses. To record this transaction, we debit miscellaneous expenses and credit cash. Expenses decrease net income, and net income is a component of retained earnings, which is reported on the balance sheet. On the statement of cash flows, the cash paid for operating expenses will be reported in the operating section. After recording this transaction, we have an ending balance in cash of $8,000 and a $4,000 balance in miscellaneous expenses. Let's assume that we decide to sell one of the parcels of land whose original cost was $3,000. Unfortunately, we were only able to sell the parcel of land for $2,800. This transaction involves three accounts: cash, land, and the loss on the sale occurring because we sold the land for less than what we had paid for it. Similar to an expense, the loss account is an income statement account that reduces net income. On the statement of cash flows, the cash received from the sale of land will be reported in the investing section. The T accounts related to the sale of land are shown here. Because our business has done well this year, we declare and pay a $2,200 dividend. Recall that the ending balance in the balance sheet account, retained earnings, is calculated as the beginning balance retained earnings plus net income minus dividends declared. Thus, declaring dividends reduces retained earnings. Finally, cash paid for dividends is reported in the financing section of the statement of cash flows. After recording this transaction, we have an ending balance in cash of $8,600. The temporary account dividends will be closed to retained earnings at the end of the period. At the end of the accounting period, which is a year in our case, we must account for implicit transactions like the use of our prepaid expenses, interest expense incurred but not yet paid, and depreciation if we own property, plant, and equipment. Adjusting entries affect both the income statement and the balance sheet, and they do not involve cash. In our example, do we need to record any adjusting entries? At the end of the year, our prepaid rent expense of $5,000 is no longer prepaid. Thus, we should reclassify it as an expense. Recall that when we prepay to rent equipment, we recorded a debit to the asset account, prepaid rent expense. Now we need to reduce the prepaid rent expense account and increase the rent expense account. To do so, we debit rent expense and credit prepaid rent expense. After recording this adjusting entry, the balance in the prepaid rent expense account is $0 and the balance in rent expense is $5,000. Recall that we borrowed money to start our business. Typically, lenders require borrowers to pay interest. In our example, let's assume that we owe $400 of interest related to the $5,000 note payable. We plan to pay this interest next month. To record this entry, we debit interest expense and credit the liability account interest payable. After recording this adjusting entry, our income statement will reflect $400 of interest expense, and the balance sheet will reflect $400 of interest payable. Let's sum up all of the information we have in our asset, liability, and equity accounts to help us prepare the financial statements. This chart is similar to an adjusted trial balance. The cash column will help us to prepare the statement of cash flows. The retained earnings column, denoted RE, will help us to prepare our income statement and the statement of retained earnings. All of the accounts will help us to prepare the balance sheet. Notice that my income statement summarizes all of the revenues and expenses and the loss that occurred over the period. As a result, the date on the income statement reflects a period of time rather than a point in time. In contrast, the balance sheet is as of a particular date. Net income of $4,400 is used to calculate the ending balance in retained earnings, which will be reported in the stockholders' equity section of the balance sheet. The sources and uses of cash over the period are classified by activity on the statement of cash flows. The sum of operating, investing, and financing cash flows is equal to the change in cash for the period. When the change is added to the beginning cash balance, the ending balance in cash is obtained. The ending cash balance is reported on the statement of cash flows and on the balance sheet as the balance in the cash account. As you can hopefully see, the financial statements relate to each other. Net income influences the statement of retained earnings and the balance sheet. The statement of cash flows shows the ending balance in the cash account, and the same information is reflected on the balance sheet in the cash account. We refer to these relations between financial statements as financial statement articulation. The important items to remember are that there is a process for recording economic events in the accounting system and that the financial statements articulate.